Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing enterprise product stock so we can determine if it's a buy or a sell. Enterprise owns, transports, and stores crude oil and natural gas. To put it simply, it makes money by storing and moving energy through its pipeline to various customers. This company is an MLP, a Master Limited Partnership. That means it pays a lot less taxes than a traditional corporation. It avoids double taxation. To qualify, the business must receive 90% of its revenue from natural resources or real estate. All dividends received from an MLP are taxed as ordinary dividends, which is the higher tax rate. Qualified dividends is the lower tax rate. You probably pay qualified dividends on most of the dividend-paying stocks you own. If you hold an MLP in your retirement account and receive more than $1,000 of dividends in a year, it is considered unrelated business taxable income, which makes it subject to being taxed immediately. For this reason, some people suggest not to have MLP stocks in a retirement account. The company is headquartered in Houston, Texas, and was founded in 1968. Let's get started with the model. This is a large cap company, 57 billion market cap. They're trading at $26 a share, and they have 2.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow went up from $2 billion to $2.6 billion in 2020. Then it really blew up to $6.3 billion in 2021. It came down to $6.1 billion in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's fairly consistent. It does go up from $4.7 billion to $5.6 billion. Revenue looks amazing. In 2020, it's $27 billion due to lower oil prices. And then it more than doubles to $58 billion in 2022, mainly due to higher oil prices. They recently released their first quarter earnings, and this is the income statement. In the first quarter of 2023, revenue of $12.4 billion, down from $13 billion in the first quarter of 2022. I'll show you a breakdown of their revenue, the $12.4 billion. Of the $12.4 billion, $5 billion was from natural gas pipelines and services, $4.2 billion from crude oil, $1.2 billion from natural gas, $2.1 billion from petrochemical and refined products. Their revenue did increase in every single category except natural gas pipelines. That decreased quite a bit, about $800 million. And that's the main reason they have lower revenue this quarter when you compare it to the same quarter in 2022. Their operating costs are $10.8 billion. A lot of that is the cost to buy the oil. Also, that includes payroll and depreciation. When you take their revenue minus their operating expenses, they have operating income of $1.7 billion, up a little from last year. They spent $314 million of interest on their debt, pretty much the same as last year. They received $12 million of interest on their investments. You can see they pay very little taxes, only $10 million in taxes, and that's pegged off of $1.4 billion. So if their tax rate was 10%, they would be paying $140 million in taxes. If the tax rate is 1%, they would be paying $14 million in taxes. They pay $10 million in taxes, so that means their tax rate is below 1%, when the average is probably like 20-25%. That's why companies become MLPs, to avoid double taxation. And since they're an MLP, they don't have shareholders, they have unit holders. Each unit holder earns 63 cents. Last year was 59 cents. They do have more units outstanding. They added some shares. Last year it was 1.3 billion shares outstanding. Now it's 1.4 billion. This is the operating section on their statement of cash flows. The purpose of operating cash flows is to convert net income to cash. They had an accounting profit of $1.4 billion, but actually generated $1.6 billion of cash flow. The way you calculate operating cash flow, you start with the $1.4 billion, then you have to add or subtract the non-cash items on the income statement. We have to add back depreciation and accretion, $454 million. You don't see accretion too much on the financial statements. Accretion is the expansion of an asset through acquisition or internal growth. But very little of this number is attributed to accretion. It's mostly depreciation. Then we have to add back $46 million of amortization of intangibles. Impairments of goodwill, $13 million. Goodwill is the premium you pay when you acquire another company. They pass through a gain of $104 million from their earnings and equity investments. These are their investments in other companies. That gain is netted out because they received a dividend payment of $104 million on their equity investments. It's usually not the same number, it's just coincidence. Like you could see last year, they reported a gain of $117 million and received $109 million in dividend payments. And then we have to adjust for changes in working capital. They had a cash outflow of $439 million. Maybe they bought some inventory, or maybe they paid back accounts payable. Last year, they had a cash inflow of $191 million. They had lower accounting profit last year, $1.3 billion compared to $1.4 billion, but a lot higher operating cash flow, mainly due to changes in working capital. This was a $600 million swing. Positive $200 million last year, negative $400 million this year. Let's look at the capital structure. $27 billion of equity, $29 billion of debt. They're 48% equity, 52% debt. Their net debt is also $29 billion. So they only have about $76 million of cash on their balance sheet. I gave them a WACC of 10.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $81 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $73 billion. We divide that by 2.2 billion shares. And we get a calculated stock price of $34. They're trading at $26, so they're trading at a 22% discount. It's a buy according to the model. Simply Wall Street is at $27 a share. They say the stock is 3% undervalued. 8 analysts priced this stock, and the average price target is 32. The low is 30, the high is 35. Another 20 analysts priced this stock, and the average price target is 32. They say the stock is 21% undervalued. This is where the stock has been trading since '98. Its lowest point was about 1 year after the IPO, in the very beginning of '99. It looks like it was as low as $1. Then it ran up to $14 in the beginning of 2001. The dot-com crash came, and it fell to about $12. Then over the next 5 years, it ran up to about $17. Then the Great Recession, it came down below $10 to about $9. Then there was a huge bull run over the next 5 years. It got past $40. So from $9 to $40. I'm not too sure if you remember, but from 2014 to 2016, oil had a big bear run. The price of oil got really low, and that's why the stock price came down to about $21 in 2016. Then over the next few months, it came back up to $30 and traded sideways for about 3 years. Before COVID, the stock was at $29. When COVID hit, the stock got down to $14, so it was cut in half. Then over the next 2 years, it broke through 25, peaking at 28, and it's been in that range ever since. Over the past 5 years, this stock is down 8%, but if you add in the dividends, it's definitely up because they pay a high dividend. The price of WTI, West Texas Intermediate, the red line, is up about 0.5%. The price of Brent crude, the yellow line, is down 3.5%. It really doesn't take much guesswork to figure out where this stock's going to go. It pretty much tracks the price of oil. As you can see, the 3 lines pretty much move in unison. They do break apart starting in mid-2021 right here, but they come back together. They pay a really nice dividend, and they raise it each year. They're up to 49 cents a share, a yield of 7.5%, which they could afford. It's 70% of their free cash flow, 76% of their net income. There are 52 companies in the same industry as Enterprise, and if Enterprise has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend a lot more than average and median in CapEx, $2.3 billion. They have a good debt-to-equity ratio. For every dollar of equity, they have $1.10 of debt. They pay a good dividend, higher than the average and median. They generate lots of free cash flow, one of the highest on this list. They rank second in market cap behind Enbridge. They do have good price multiples, but most of them are worse than the median. All their price multiples are better than the average, especially their price of sales that's 1.0. It's actually a little better than 1.0. If it was exactly 1.0, that means their revenue would be exactly their market cap. But their revenue is higher than their market cap, so it's slightly below 1.0. It's 0.98 about. And their 5-year annual revenue growth rate is 13% higher than the median. So to summarize, I have them trading at a 22% discount. They've been around 55 years. They pay a great dividend. They generate lots of free cash flow, lots of revenue. So what more can you ask for? I rank their free cash flow 7 out of 10, their revenue 9 out of 10, and their ratio 7 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to become a member, you click on the link in the description below. Thanks for watching.